Congratulations, President-elect Joe Biden and Vice President-elect Kamala Harris. Joe Biden will make a $2 trillion accelerated investment with a vision to achieve a clean energy future. A big chunk of these investments will be across the electric vehicles, energy sector, and mass transportation. On his website, the president-elect has laid out a plan with a vision to achieve a clean energy future. The following are some of the highlights of the plan. Provide every American city with 100,000 or more residents with high-quality, zero-emissions public transportation options. Move ambitiously to generate clean, American-made electricity to achieve a carbon pollution-free power sector by 2035. Create 1 million new jobs in the American auto industry and auto infrastructure, from parts to materials to electric vehicle charging stations. These policy changes will create huge tailwinds for a few companies in the American energy and electric vehicle sector. In this video, we will analyze what are those potential companies and how we as stock market investors can benefit from investing in those companies. Using this as the starting point, I have analyzed energy and electric vehicle stocks to pick out those companies that have great long-term prospects. The three ground rules that I have taken into consideration while selecting these companies are as follows. The companies that I have selected should have earnings, not just revenues. There has been an infusion of electric vehicle stocks that have no revenues and no production-ready product. These companies have been demanding a sky-high valuation. I have excluded these companies from my stock picks. The companies should not be highly levered, meaning the companies should be having manageable debt on their balance sheet. This is important because as the interest rates rise in the future, the companies with low debt will have access to capital to fund their growth. The management of the companies should be shareholder friendly and be willing to give out dividends. In case they are not giving dividends, they should be investing their capital in opportunities that provide a very high rate of return. Hi, I'm Arshad Ahmed, founder of DIYstockpicker.com, an investment portal dedicated to help investors make intelligent decisions. This video is for information purposes and please do your due diligence before making any investment decisions. With that, we'll get started with the video, and the first company on the list is NextEra Energy. Operates rate-regulated electric utilities that distribute power to consumers and businesses. The company also generates electricity and transports natural gas under long-term fixed-rate agreements. NextEra Energy produces more electricity from wind and sun than any other company in the world. There is a secure dividend and growth potential available with renewable energy. NextEra Energy has a very good relationship with the regulators in Florida, and that is because they sell electricity 20% cheaper than the nearest rival. That lets the company spend about $60 billion for growth. NextEra acquires utilities, cuts down the operation cost by 50%, and passes those savings to the consumers. The company also controls the yieldco NextEra Energy Partners, ticker symbol NEP. This yieldco sells contracted clean energy assets to its affiliate for cash to invest in new growth opportunities. Between 2004 and 2019, the company's earnings per share have grown at a compounded rate of 8.4%, while the dividend has grown at a compounded rate of 9.4%. The company's stock also split 4-for-1 recently. Though nothing changes fundamentally for the company, but the less stock price makes it accessible to a wide range of investors. That may put some tailwinds for the growth of the stock. Tesla is getting better and better each quarter. The recent quarter was the 5th consecutive quarter with positive cash flow. Tesla is not just an electric vehicle car company, but it is also a growth technology stock. It has 4 to 5 businesses running within the main business, and each business is a seed that has the potential to grow into its own tree bearing fruit, meaning cash for the shareholders. Tesla Battery Day was held recently. The company plans to manufacture its own tabless batteries, which increase the range and power for the electric cars. The company plans to manufacture its own batteries in-house, which will further reduce the cost of the electric vehicles. Elon Musk says that in a couple of years, Tesla will have a $25,000 electric car. Tesla has about $14.5 billion cash on its balance sheet. The company recently raised $5 billion in cash by issuing new shares. When the stock price of a company is high and the stock is in demand, smart capital allocation dictates that the management raise capital by issuing equity or new shares rather than by adding debt. This was a very smart capital allocation move on the part of management. Fremont Gigafactory is producing currently 500,000 units per year. Shanghai Gigafactory capacity has been increased to 250,000 units. Model 3 is currently the lowest priced premium mid-size sedan in China. Berlin Gigafactory construction is under progress and production is expected to start start in 2021. The company also recently released the full self-driving module for its autonomous vehicle pursuit. Tesla stock has been volatile recently, but if you're holding it for the long run, the stock is worth every single penny and more, and it sure will produce great returns for its shareholders over the next 5 to 10 years. ChargePoint, the world's largest provider of electric vehicle charging stations, is going public with a reverse merger agreement. The company is using the special purpose acquisition company Switchback Energy, ticker symbol SBE, for its IPO. The deal is worth $2.4 billion. Founded in 2007, ChargePoint is a category creator in electric vehicle charging. They operate in every segment from residential to commercial to fleet. ChargePoint has created the world's largest charging network by using a capital light model. They sell the individual organization and businesses everything they need to electrify their charging spaces: hardware, software, subscription services, and support. The parking spaces that are owned by the site hosts are seamlessly integrated into one network, and they are available to the drivers in a top-rated mobile app. This drives recurring SaaS revenue and satisfied drivers. ChargePoint has attracted more than 4,000 organizations and businesses. It has built a network of more than 115,000 public and private places to charge. ChargePoint also provides access to more than 133,000 parking spaces through its network integration roaming across North America and Europe. Drivers plug into the ChargePoint network every 2 seconds and have completed more than 80 million charges to date. Electric vehicle charging infrastructure is projected to be $190 billion by 2030. And with the cash raised from its IPO, ChargePoint will be in a very good position to take advantage of all those opportunities in the future. First Solar is an all-American company. The company manufactures solar modules with an advanced semiconductor technology. By constantly decreasing its manufacturing costs, First Solar is providing an alternative which is affordable and environmentally responsible to the fossil fuel generation. The company has moved away from markets that are heavily dependent on government subsidies to utility-scale photovoltaic systems in markets with immediate need. First Solar has shipped 25 gigawatts solar modules worldwide. The company also has a 12 gigawatt contracted backlog of deliverables from 2020 through 2023. The capacity of installed solar globally is expected to double in the next 5 years. The company has a great balance sheet with a cash of $1.64 billion and a very low debt of only $261 million. Thus, it is positioned nicely to take advantage of all these growth opportunities. All the factories are 100% utilized capacity-wise. The manufacturing process is vertically integrated, thereby reducing any disruptions in the supply chain. This is one of the main reasons why the company came out with minimal impact from the pandemic lockdowns. In the third quarter of 2020, the company blew past all the analyst expectations. First Solar had a revenue of $928 million, 70% increase year over year. It had an earnings per share of $1.42, way over the 62 cents that the analysts were projecting. The equity of the company also keeps growing every quarter, year over year, which is a very good indicator of the health of the company. So those were the 4 stocks which would be a good bet to purchase over the long term. These companies will be having tailwinds from the Biden plan and the federal spending. I have also analyzed LiDAR stocks, which you will see here on the end screen. These are very detailed analysis and the videos are very interesting, and I hope to see you in those videos. Take care.